Hello, and welcome back to the channel. Today we're tackling a question on many investors' minds. After an absolutely meteoric rise driven by the AI revolution, is NVIDIA stock, ticker NVDA, still a smart buy right now in mid-2025? NVIDIA has been a market darling, a key enabler of artificial intelligence, and a portfolio maker for many. But the stock has seen increased volatility recently. Concerns about valuation, competition, and geopolitics are swirling. So is the party over? Or is this just a pause before the next leg up? Is NVIDIA overvalued, or is the premium justified? In this video, we're doing a deep dive analysis. We'll dissect NVIDIA's latest financial results, explore its powerful growth drivers, critically examine the significant risks and challenges, look at valuation metrics and analyst opinions, and ultimately provide a balanced perspective to help you form your own conclusions. Stick around, because we have a lot of ground to cover based on the latest information. First, a quick refresher on what NVIDIA actually does. Founded back in 1993, NVIDIA initially made its name designing graphics processing units, or GPUs, primarily for the PC gaming market, with its popular GeForce line. However, under the leadership of co-founder and CEO Jensen Huang, NVIDIA strategically pivoted and expanded its horizons. They realized the parallel processing power of their GPUs was incredibly well-suited for demanding computational tasks beyond graphics. This led to their dominance in the professional visualization market with Quadro GPUs, and more importantly, their emergence as the key hardware provider for the artificial intelligence boom, particularly in data centers. Their CUDA software platform created a powerful ecosystem, locking developers into their hardware for AI model training and inference. Today, NVIDIA business is broadly divided into segments like data center, gaming, professional visualization, and automotive. NVIDIA stock delivered truly staggering returns in 2023, climbing around 240%, and continued that momentum into 2024, with another gain reported by some sources as over 190%, pushing its market capitalization into the trillions. This surge was fueled by blowout earnings report after blowout earnings report, driven by insatiable demand for its AI chips. However, 2025 has seen more turbulence. While the stock saw some recovery recently, gaining nearly 14% over 5 days. In mid-April, according to one report, it was still down significantly year-to-date at that point, perhaps around 18.5%. This pullback reflects a mix of profit-taking after the huge run-up, concerns about rising competition, the sustainability of its incredible growth rates, and significantly escalating geopolitical tensions, particularly new U.S. export restrictions impacting sales to China. Now, let's dive into the numbers. NVIDIA reported its fiscal year 2025 fourth quarter results on February 26, 2025, covering the period ending January 26. Revenue for that quarter, Q4, was a record $39.03 billion. That's up a massive 78% compared to the same quarter a year ago, and also up 12% from the previous quarter, Q3. This beat analyst expectations for the full fiscal year 2025. NVIDIA pulled in a staggering $130.05 billion in revenue, a remarkable 104 from the $60.09 billion reported in fiscal year 2024. Where is this incredible growth coming from? Primarily the data center segment. In Q4, data center revenue hit a record $35.06 billion. That's up 93% year-over-year and 16% sequentially. For the full fiscal year, data center revenue soared 142% to reach $115.02 billion, making up roughly 8% of the company's total annual revenue. The AI boom is clearly fueling this. On the other hand, the gaming segment showed some softness in Q4. Revenue was $2.05 billion, which was actually down 11% compared to the prior year's Q4 and down 22% from the previous quarter, Q3. This suggests some potential cyclicality. or market saturation returning in the consumer gaming space after a period of strong demand. However, for the full fiscal year, gaming revenue still managed a 9% increase to $11.04 billion. Professional visualization and automotive segments contribute smaller portions to the overall revenue pie. Now let's look at profitability. In Q4 fiscal 2025, GOP earnings per diluted share EPS was 89 cents, up 82% year-over-year and 14% sequential. Non-GAAP EPS, which adjusts for certain items, was also 89 cents, up 71% year-over-year and 10% sequentially. For the full fiscal year 2025, GOP's was $2.94, a stunning 147% increase from the previous. Non-GAAP EPS for the full year was $2.99, up 130% year-over-year. Incredible bottom-line growth. What about margins? This is an interesting area. In Q4, GAAP gross margin was 73.0%, which was actually down 3 percentage points from 76.0% in the. Similarly, non-GAAP gross margin was 73.5%, down 3.2 percentage points from 76.7% in Q4. This slight compression in Q4 margins, despite soaring revenue, might be due to product mix shifts, potentially related to the ramp-up of newer products or perhaps specific deals. However, looking at the full fiscal year 2025, gross margins did improve year-over-year. GOP gross margin was 75.0%, up 2.3 points, and non-GAAP gross margin was 75.5%, up 1.7 points compared to fiscal year 2024. Operating expenses are also rising significantly as NVIDIA invests heavily. Q4 GOP operating expenses were $4.69 billion, up 48% year-over-year. Non-GAAP operating expenses were $3.38 billion. For the full year, GOP OPs jumped 45% to $16.04 billion, and non-GAAP OPs rose 50% to $11. This reflects massive investments in research and development for future products like Blackwell, as well as scaling up sales and marketing efforts globally. The balance sheet remains strong. NVIDIA ended the fiscal year with $43.02 billion in cash equivalents, and marketable securities, a significant increase from $26 billion a year prior. Finally, let's look at the company's guidance. For the first quarter of fiscal year 2026, which would roughly be the Feb-April 2025 period, NVIDIA expected revenue to be around $43 billion, plus or minus 2%. This indicates continued sequential growth from the $39.03 billion reported in Q4. However, they guided for gross margins to dip slightly further in Cone. GOP gross margin expected around 70.6% and non-GOP around 71.0%. This continues the trend seen in Q4 and warrants monitoring. Operating expenses are also guided to increase further in Q1, with GOPX around $5.02 billion and non-GOP OPEX around $3.06 billion. Overall, the financial picture is one of explosive AI-driven growth, particularly in the data center, coupled with significantly increasing investments and some recent mild pressure on gross margins. Now, what's fueling this phenomenal growth, and what does the future hold? The primary driver, without a doubt, is the artificial intelligence megatrend. NVIDIA is at the epicenter. Their GPUs, like the previous generation Hopper H100A100 and the upcoming Blackwell B200 and GB200, have become the industry standard for training large language models and other complex AI systems. Demand from hyperscale cloud providers like Amazon AWS, Microsoft Azure, Google Cloud, and Oracle Cloud, as well as large enterprises building their own AI infrastructure, has been insatiable. Reports suggest NVIDIA holds around 80% or more of the AI accelerator market share. Beyond just training, NVIDIA is also pushing hard into AI inference, the process of running trained models, and the emerging field of AI reasoning, where AI models perform more complex, multi-step problem solving. Crucially, NVIDIA Advantage isn't just hardware, it's CUDA software platform, and associated libraries like cuDNN's TensorRT create a deep and wide ecosystem moat. Millions of developers are familiar with CUDA, making it costly and time-consuming for customers to switch to competing hardware platforms. NVIDIA continues to build on this, with offerings like NVIDIA AI Enterprise, NVIDIA NIM microservices for deploying AI models, and specialized platforms for industries like healthcare, MonEye, and automotive. The next major catalyst is the Blackwell architecture. Announced with significant fanfare, Blackwell represents a major leap in performance and capability over Hopper. The Blackwell GPU features 208 billion transistors, built on a custom TSMC-4NP process. It uniquely combines two large dies into a single unified GPU connected by a blistering 10 terabyte per second interface, offering up to 20 petaflops of AI performance on a single chip. It includes a second-generation transformer engine optimized for large language models and mixture of experts models, a new decompression engine to accelerate data analytics, claiming up to 18x faster performance than CPU in database queries, and fifth-generation NVLink interconnects, offering 1.8 terabytes per second of chip-to-chip bandwidth. NVIDIA is packaging Blackwell into powerful systems like the GB200NVL72, which connects 72 Blackwell GPUs with 36 Grace CPU. In a liquid-cooled rack-scale design, they've also announced Blackwell Ultra systems like GB300NVL72 and HGXB300NVL16, specifically targeting and claiming significant performance boosts over the initial Blackwell offerings and even greater revenue potential. Analyst expectations for Blackwell are sky-high. Some predict it could drive over 50% growth in data center revenue next year, with certain bullish forecasts suggesting Blackwell alone could generate hundreds of billions in revenue over its life cycle. Availability is expected to ramp up in the second half of 2025, so this will be a key factor to watch. Beyond the data center, other areas offer long-term potential. Gaming, despite recent softness, remains a significant business. New GPU generations with features like ray tracing and DLSS drive upgrade cycles, and the PC gaming market has proven resilient. The automotive segment, powered by the NVIDIA Drive platform Orin and the future Thor superchip, is a longer-term play targeting autonomous driving and next-generation in-vehicle infotainment and AI systems. Partnerships with numerous automakers position NVIDIA well if autonomous technology matures. NVIDIA Omniverse, a platform for building and operating metaverse applications and digital twins, also presents a significant, though perhaps more distant growth opportunity. NVIDIA is also expanding its partnerships, collaborating with companies like Cisco on AI networking infrastructure, Verizon on Edge AI, and major players in healthcare and life sciences like IQVIA, Illumina, and Mayo Clinic. They recently announced serving as a key technology partner for the massive $500 billion Stargate AI supercomputer project. In summary, the growth narrative is powered by continued AI dominance, expansion into inference and reasoning, the highly anticipated Blackwell product cycle, and long-term potential in automotive and software platforms. However, no investment is without risk, and NVIDIA faces several significant ones. The most frequently cited concern is valuation. After its incredible run, NVIDIA trades at very high multiples compared to the broader market and even many tech peers, although perhaps less so. On a forward basis, if its ambitious growth forecasts materialize, the stock price already discounts enormous future growth. Any signs of deceleration or failure to meet lofty expectations could lead to significant multiple compression, meaning the stock price could fall even if the business continues to grow. Some analysts explicitly warn of AI bubble fears and view NVIDIA valuation as overly expensive or stretched. The law of large numbers also comes into play. It becomes mathematically harder for a company of NVIDIA massive size to continue doubling or tripling revenues year after year indefinitely. The second major risk is competition. While NVIDIA dominates today, competitors are intensifying their efforts to capture a piece of the lucrative AI pie. AMD is making a strong push with its Instinct MI300 series accelerators, targeting over $2 billion in AI chip revenue. In 2024, according to some reports, AMD competes directly in both high-performance GPUs and CPU. Intel is also vying for AI business with its gaudy accelerators, positioning them as a potentially more cost-effective alternative to NVIDIA offerings, aiming to be significantly cheaper than the H100, for instance. Perhaps even more significantly, NVIDIA's largest customers, the hyperscale cloud providers like Google, Amazon, Microsoft, and Meta, are all investing heavily in developing their own custom AI silicon, like Google's TPU, AWS's Trainium and Inferentia, Microsoft's Maya. While these may not replace NVIDIA entirely, they could chip away at NVIDIA market share over time, especially for specific workloads, and increase the bargaining power of these large customers. There's also the emergence of players like DeepSeek AI in China, demonstrating the ability to develop competitive AI models, potentially using older or less powerful hardware, which could challenge the narrative that only the absolute latest, most expensive chips are necessary for cutting-edge AI. Third, geopolitical risk, especially concerning China, is a major and growing headwind. The US government has implemented increasingly strict export controls on advanced AI chips and semiconductor manufacturing equipment to China, directly impacting NVIDIA. China, which once represented around 20% of NVIDIA revenue, shrank to about 10% recently due to these restrictions. In April 2025, NVIDIA disclosed it expects to take a massive $5.05 billion charge related to inventory write-offs for its H20 chip, a product specifically designed to comply with earlier US restrictions for the Chinese market, as new, tighter restrictions have apparently made even these chips unsellable to China. This highlights the significant financial impact and uncertainty stemming from the US-China tech tensions. Some analysts, like those at Morningstar, now forecast NVIDIA China revenue falling to nearly zero and have lowered their fair value estimates for the stock, partly due to this. There's ongoing risk of further restrictions, potential Chinese retaliation, and disruption to global supply chains. Fourth, there's the risk of cyclicality and a potential slowdown in spending. The semiconductor industry is historically cyclical. While AI demand seems secular, the current pace of infrastructure build-out by hyperscalers might not be sustainable indefinitely. At some point, companies may pause or moderate spending to assess the return on their massive AI investments, shifting focus from building capacity to monetization. A broader economic slowdown could also impact demand for NVIDIA products, particularly in the more consumer-sensitive gaming segment or delay enterprise AI projects. The recent dip in gaming revenue could be an early sign. NVIDIA's heavy reliance on a small number of very large hyperscaler customers also poses a risk. A change in spending plans by just one or two of these giants could significantly impact NVIDIA results. Fifth, execution risk remains. NVIDIA needs to successfully ramp up production and delivery of its complex Blackwell systems. Reports have mentioned potential bottlenecks, for instance with NVLink switches, that could slow down deliveries even if GPU supply improves. Managing its complex global supply chain, heavily reliant on manufacturers like TSMC, is crucial. Any disruptions, whether geopolitical or logistical, could impact production. Finally, regulatory scrutiny could pose challenges, particularly around antitrust concerns given NVIDIA's dominant market position. Although specific actions haven't significantly materialized recently. So, with these growth drivers and risks in mind, how is the stock valued? As mentioned, traditional trailing valuation metrics like price-to-earnings (PE) or price-to-sales (PES) look very high compared to historical averages and the broader market. However, bulls argue that looking at forward multiples based on projected earnings growth makes the valuation seem more reasonable or even compelling. According to some analysts like Bank of America, if NVIDIA achieves the massive growth expected in the coming years. For instance, based on consensus analyst estimates for fiscal year 2026, ending Jan 2026, EPS of around $4.53, a stock price around $110, $120 would imply a forward PE in the mid-20s. For fiscal year 2027, EBS estimate the forward PE drops below 20. These levels are much lower than recent trailing PE ratios. But, and this is a huge caveat, this relies entirely on NVIDIA hitting those extremely high growth targets. For both revenue analysts estimate around $204 B for FY26 and $251 B for FY. Any significant miss could make the current valuation look very expensive again. What are Wall Street analysts saying? The consensus rating remains overwhelmingly positive, generally a buy or strong buy. One source tracking 63 analysts in mid-April 2025 found 43% rated it strong buy and 41% buy, totaling 84% positive. Only 10% recommended hold and a small minority 7% suggested sell or strong sell. However, price targets show a wide dispersion. Recent reports mention average 12-month price targets ranging from around $178 to $226, depending on the source and type. The range of individual targets is even wider, with one source citing a range of $135 to $220. Specific recent targets include Bank of America at $200, raised from $190, Mizuho at $168, reiterate, and Morningstar with a fair value estimate lowered to $125 due to heightened China restrictions. This disparity reflects the high uncertainty surrounding NVIDIA future growth trajectory and the impact of the risks we've discussed, especially geopolitics. Some analysts remain incredibly bullish, like Beth Kindig, who called NVIDIA the stock of the decade and predicted a 70% upside in 2025 driven by massive Blackwell revenue. Others, like Elliott Management, according to reports, have warned AI might be overhyped and NVIDIA could be in a bubble. So, after this deep dive, we arrive back at the main question: is NVIDIA stock still a buy? As you've seen, there's no simple yes or no answer. Let's summarize the arguments. The bull case rests on several strong pillars. NVIDIA undisputed leadership in the crucial AI hardware market, fortified by its powerful CUDA software ecosystem, which creates high switching costs. The company is riding a massive secular growth trend in AI, data center expansion, and potentially automotive and simulation. The upcoming Blackwell platform promises another significant leap in performance and is expected to drive substantial revenue growth. NVIDIA has a strong track record of execution under visionary leadership, and despite high trailing multiples, forward valuation metrics could look attractive if the company continues its phenomenal growth trajectory. Many analysts view recent pullbacks as buying opportunities for long-term investors. The bear case, however, raises serious red flags. The current valuation is undeniably high, pricing in near-perfect execution and enormous sustained growth, making the stock vulnerable to any disappointments. Competition is intensifying from established players like AMD and Intel, and crucially, from NVIDIA-owned largest customers, developing custom silicon which could erode market share and pricing power over time. Geopolitical risks, particularly US-China tensions and export restrictions, pose a significant and growing threat, already resulting in substantial financial write-offs and loss of a major market. This uncertainty is likely to persist. There's a risk of a slowdown in the current feverish pace of AI infrastructure spending as companies reassess ROI, or broader economic headwinds impacting demand. The recent gaming softness could be a precursor. Execution risks in ramping up Blackwell and managing supply chains at this massive scale are non-trivial. So, what's the verdict? For a long-term investor with a high-risk tolerance who strongly believes in the enduring AI revolution and NVIDIA's ability to maintain its technological lead despite competition and geopolitical headwinds, accumulating shares perhaps particularly on significant dips caused by near-term volatility or concerns, might still seem attractive as part of a diversified portfolio. The potential for continued growth driven by Blackwell and expanding AI applications remains immense. However, for investors with a lower risk tolerance, or those concerned about the very high valuation, the increasing competition, and especially the unpredictable geopolitical landscape impacting the China market, the stock looks considerably riskier today than it did a year or two ago. The potential for significant downside volatility is real if growth falters, or if geopolitical risks escalate further, waiting for a more attractive entry point after further potential correction or confirmation of sustained Blackwell momentum. And managed geopolitical fallout might be a prudent approach for some. Short-term traders face significant volatility driven by news flow around earnings, product launches, competition, and especially US-China relations. Ultimately, the decision depends on your individual investment goals, time horizon, and crucially, of one of the most transformative technological shifts of our time, artificial intelligence. Its financial performance has been extraordinary, and its future growth potential, particularly with Blackwell, remains enormous. However, the stock also carries substantial risks related to its sky-high valuation, intensifying competition, potential demand cyclicality, and significant, unpredictable geopolitical headwinds, especially concerning China. Whether it's still a buy is a complex question with valid arguments on both sides. Thorough due diligence, careful consideration of your own risk profile, and ongoing monitoring of the key factors we've discussed are essential. What are your thoughts on NVIDIA? Is it still a buy, a hold, or a sell in your opinion? Let us know in the comments below. We'd love to hear your perspective. If you found this deep dive helpful, please give the video a thumbs up and subscribe for more stock analysis content. And as always, remember this video is for informational and educational purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Thanks for watching.